Welcome to the Zone of Genius, the podcast where money talk meets real talk. I'm Dana Wilson, founder and CEO of CHIP, which stands for Changing How Individuals Prosper, the financial services marketplace connecting you to trusted financial professionals who get it. You'll hear from experts from our platform who break things down in a way that's honest, actionable, and easy to understand. Whether you're building wealth, healing financial trauma, or just figuring out your next move, this is your go-to spot for real conversations that move you forward. This is your zone to learn, grow, and take charge of your financial story, one empowering conversation at a time. If this episode hits home, subscribe, share it with your people, and of course, leave us a review. And when you're ready to build your financial team, head to chipprofessionals.com to find the right pro for you. We'll see you there. All right. Hello, everyone. Welcome back to another episode of the Zone of Genius podcast, where we focus on real talk, real money, straight to the point topics that are important to you. Again, my name is Dana Wilson, CEO and founder of CHIP, which stands for Changing How Individuals Prosper. And we're here to ensure that you get connected to great financial professionals who are doing amazing work and are willing and ready to work with you and help you through all of the financial needs that you might have. So really excited to dive into this topic on real estate taxation with Bill Hampton. Bill, welcome to the podcast.
Well, hello, Dana. Thank you for having me.
Yeah, absolutely. And before we dive into this topic, because I'm sure, a lot of people, if you're in real estate, trying to get into real estate, this is an important one. But please tell everyone who you are and what you do.
Sure. My name is Bill Hampton. I am the owner of Hampton Tax and Financial Services. My firm is located in the Atlanta area. We specialize in real estate taxation. We work with a lot of real estate investors. We also, besides doing tax preparation, we do tax planning, financial planning, and business consulting for our clients.
Awesome. Well, I know everyone listening is ready to dig right in. So of course, if you're in the Atlanta area, they're right in your backyard. So make sure you jump on over and have a conversation with Bill once we're finished and we get through all of the amazing thoughts and things around real estate tax. So let's jump on in here. So what makes real estate such a unique asset class from a tax perspective compared to other investments? I feel like a lot of people are starting to jump into understanding more about it.
Sure. So what makes real estate unique is that depending upon what type of real estate investment you have, you can have almost, hundreds of thousands worth of losses that you can write off against your W-2 income. Whereas if you have investments in the stock market, your losses are limited to, $3,000 a year. But with real estate investing, if you have long-term rentals, you can deduct up to $25,000 against your ordinary income. If you have a short-term rental, you could, have much more in deductions, particularly if you use certain strategies like cost segregations, and you can get, tens, hundreds of thousands of dollars in tax deductions that you can utilize to offset your W-2 income. So that's what's so great about it, and that's why it's a, better tax advantage investment than your typical stock market investments.
Yeah, that makes sense, especially if you're a business owner. If you are a business owner, is that something that, business owners can take advantage of as well? Are there any differences there between owning as a business or, individually?
No, there aren't really differences as far as if you own real estate through a business like an LLC or if you own it personally. There are no extra tax deductions that you get from an LLC that you wouldn't get if you just had it in your own name. But as a business owner, if you own a business outside of real estate, you also can take a lot of deductions, but they're a little bit different than the deductions that you can take as a real estate investor.
Gotcha. Makes perfect sense. So what are some of the biggest misconceptions or common mistakes you see among real estate investors?
Okay, so that's a good question. So the most common misconception I see revolves around how you can take the deductions as a real estate investor. So the IRS has rules that that you put in place for real estate investing, and one of those rules, and probably the most important rule, and the rule that causes the most misconceptions, is the passive loss limits. So let me explain what that means. So as I said, you can take up to $25,000 in losses on a long-term rental, but it depends on your income. So the IRS has income limits, and the income limits are $100,000. So if you make $100,000 or less, whether you're a single person or a couple, you can take up to $25,000 in losses from your real estate investments, from your long-term rental. If you make more than $100,000 as an individual or as a couple, those the capability to take those losses sort of phases out. And then once you hit $150,000 in income, whether that's single or whether that's, combined income, a married couple, your losses are suspended and you can't use them in that year. And so a lot of people that are high earners get into real estate and they think they're going to be able to write off some of their W-2 income with losses, but the IRS has passive, loss limits that don't allow it. And so they're surprised by that. So a lot of times either they're getting bad information or they're just not getting information at all about that particular IRS rule. And then they, are shocked sometimes when they come to me to get their taxes done.
Yeah, I'm sure shocked, disappointed, and all the things that kind of come with that, especially if they're not talking to a professional and making a lot of these decisions. So, that can cause even more, not only stress, but, financial, that's more money out of your pocket.
Absolutely.
Yeah, so I guess that kind of goes into my next question around, can you break down how depreciation works and why it's so powerful as a tax tool, and especially when it comes to the real estate side of things?
Sure. So the IRS lets you depreciate a rental property when you buy it. You can depreciate the building, but you cannot depreciate the land. So that's an important distinction. So if you buy a property, let's say you buy a house and you pay $100,000 for it, we'll just use a round number. And the county that you live in puts a value on the building structure and the land structure. Now, they may not tell you the building is worth $100,000. They may have it worth $80,000 or $50,000. But whatever they have it priced at, they break down on the county tax assessor's website the land value and the building value. Well, as a real estate, accountant, we have to get that information. We have to use that. So if let's say you buy a house, you pay $100,000 for it. We go to the county tax assessor's website, and they'll say they value the house at, let's say, $50,000, or the property's at $50,000. $40,000 would be the building. $10,000 would be the land. So basically, you're looking at an 80-20 split there between building and land. So when me as your accountant, we have to do your depreciation. We're going to use that same ratio, and so we're going to take the $100,000 house and say, well, $80,000 of it, or 80%, would be building value. The other 20% would be the land value. So what we would do is we would depreciate that $80,000 over 27 and a half years if it's a long-term rental. If it's a short-term rental, you have to depreciate over 39 years. And that's another thing about depreciation. Long-term rentals are considered commercial properties. It's basically like you're running a hotel. So the depreciation period is different than a long-term rental where you have a tenant for, let's say 12 months. With a short-term rental, you're commonly having tenants that are there for a week or less, or weekend or something like that. So there's different depreciation schedules there between those two types of properties.
Is this something that a lot of people should be thinking about when it comes to even Airbnb? Because as you're talking about tenants and things like that, and I know now they have those, short-term rentals and leases that they've also built into Airbnb. And there's a lot of people that do that. Are there things that they should be thinking about, especially in relation to this?
Absolutely. So, as I said earlier, short-term rentals have a different depreciation period. It's 39 years. So a lot of times there are some strategies that you can utilize if you own a short-term rental to take advantage of that long depreciation period. Specifically, we can do what's called a cost segregation study, which means we'll have professional engineers go out to a property and then place values on the different components in the property. That means they'll place a value on the HVAC system, the plumbing system, et cetera. And what they'll do is, they'll go into the property and give a value for the paint on the walls, the carpet, or the hardwood floors. And then once you do a cost segregation study, you can depreciate these items over a shorter time frame, usually 5 years, 7 years, 15 years, versus waiting for the full 39 years to get your depreciation. Honestly, most investors are not holding a rental property for 39 years, and they're probably not even going to hold it for 27 and a half years. So by getting a cost segregation study and utilizing accelerated depreciation on a short-term rental, you can get, some of that depreciation quicker than waiting the 39 years. And that's one of the strategies I commonly use for my short-term rental clients to get them larger tax deductions.
Yeah, absolutely. And I just want to stay here for a second because how important is it for people to really do some of their, some of their own research along with their financial professional that they're working with, especially around understanding maybe even state to state laws and nuances, especially as they're looking at real estate property?
Mm-hmm. Well,
or are there normal differences there, or does that even tend to matter sometimes?
Not really. The depreciation that you're taking on your biggest deduction is going to be on your federal tax return. Obviously there are some deductions you can take at the state level, but the biggest real estate deductions for real estate investors are at the federal level, like depreciation, property taxes, mortgage interest, et cetera, et cetera. So the state doesn't really matter, but it does matter who you utilize or who you consult with. A lot of times I find that your typical accountant who doesn't specialize in real estate taxation may not understand all the nuances. They may not know the difference between 27.5-year depreciation, 39-year depreciation. They may not know what a cost segregation study is, how it can benefit clients. So if you're getting into this space, you want to work with an accountant or an advisor who understands real estate taxation, and you want to work with them sooner rather than later. You don't want to, hey, buy a property in July, and then I'm going to contact the accountant in, January, February, and try to figure it out. I tell my clients, you need to have a consultation with your accountant or your advisor before you even think about buying a property, because there's a lot of things we can help you with, like strategy on how to, finance the property, strategies on, if you should sell a property, whether you should do long-term rentals, whether you should do short-term rentals. So there's a lot of things out there that an advisor can help you with and save you tens of thousands of dollars by helping you up front, because a lot of times when you buy a property, the profit is made when you buy it versus when you sell it. So you got to buy it at the right price. If you want to definitely find the best financing you can afford, and you want to make sure you get all of the deductions that you're eligible to take, and the timing of that matters tremendously. So let me give you an example. If someone decides, hey, I'm going to buy a property later in the year, and they decide to fix it up, if they don't have that property rented out and have a tenant in it before December 31st, they're not able to take deductions on all the money they spent. And that's another common surprise that, investors see. They're like, oh, I'm going to buy this property and I'm going to take 6 months to get it, ready, get it the way I want. And then they think, okay, I'm going to be able to deduct everything on my 2025 tax return, but I didn't put a tenant in until early 2026. And I have to give them the bad news that the IRS does not allow you to take those deductions if the property is what we call in service. And that means has a tenant in it or it's advertised for rent. So that's another area where you definitely want to work with a real estate accountant to make sure you time the buying of your investment and the renting of that investment so you can get the deductions that you're entitled to.
Wow. Yeah, I would say that's a pretty big deal. Probably because I know a lot of times we all jump in to do things and we're just like, we'll figure it out later. And you put the costs in because you want everything just right, or at least, somewhat together before you have someone in there. But then it's just like, you don't really get to recoup any of that money that you've just spent in any kind of way. It doesn't benefit you.
Well, you will get it in the year that you put it in, but that's later. If you were looking for it to get at the end of that year when your 2025 tax return, then you're going to be waiting a year to get those deductions. So you will get them. You just won't get them when you expect them.
Just not when you might need it.
Exactly.
Well, it kind of changes hats a little bit. How can someone use their 1031 exchange to grow their portfolio while deferring their taxes?
Sure. So a 1031 exchange is a common strategy that real estate investors use when they're looking to sell a property. Let's say, you buy a property at $100,000, you rent it out for several years, 5-10 years, and you're like, okay, I want to use some of the equity in this property and I want to buy another property. Well, you can do what's called a 1031 exchange, which means that you hire someone to facilitate you transferring the money from the sale of the property, and they allow you to use it to buy a new property. And usually the new property that you buy is more expensive than the first property, which allows you to defer taxation. So that's basically what a 1031 exchange is. And a lot of times in the industry, we call it, buying up. Let's say you buy a, $100,000 property, it appreciates, several years later, 10 years later, is worth $500,000. You got a $400,000 gain. You don't want to pay tax on that. you sell it, you get the $500,000, and you use that to buy a more expensive property, let's say $1 million property, and that's your down payment. Or you could use it to buy a commercial property, multifamily property, et cetera, et cetera. And because you're doing the 1031 exchange and you're taking the profit and immediately buying another property with it, you're able to defer the taxes based on IRS regulations. And that's a very, really good strategy that, clients can utilize to buy more properties, but not pay taxes on the property that they sell.
On that note too, like when does it make sense for someone to hold a property in an LLC or another entity from a tax standpoint?
Well, from a tax standpoint, the LLC doesn't give you any extra tax deductions. An LLC is commonly used for what we call asset protection, and in case you get sued. So if you have the property in an LLC, it's not going to give you any extra tax deductions. It might not even stop somebody from suing you, but it limits your liability in case you get sued. So that's another common misconception. People think that, I have to have an LLC, or otherwise I don't get to take any tax deductions like mortgage interest, property taxes, and depreciation. That's actually, not correct. If you own the property in your name, you never get an LLC, which a lot of times investors do. They just get, landlord insurance. They're able to take the same deductions that people that have an LLC, have. Now, you can also put a property into a trust. Now, a trust doesn't give you any tax deductions either, but it's good for estate planning purposes. So that way, your heirs can take over the management of the property. If you're disabled, if you're, hospitalized, or, if you pass away, it avoids probate. So that's a benefit of having a trust, having your property in a trust.
Yeah, absolutely. And I feel like there's so many misconceptions about what it means to have a trust and really be able to establish that in the first place. So we'll have to, unpack more of that in another episode. So what qualifies as a legitimate real estate write-off, and where do people get that wrong?
Okay. Well, there are so many deductions that you can take. And the way the IRS phrases is that whether it has to be ordinary and necessary. And ordinary and necessary, can come with different interpretations, but your most common deductions that you're going to see are mortgage interest, property taxes, depreciation, travel. If you have a property that you have to drive to or you have to fly to, if you have an out-of-state property, which is common with short-term rentals, usually those are in vacation areas like Orlando or Gatlinburg or someplace like that. So travel is one. Business meals, airfare, hotels. If you go out of state and you buy a property, you have to stay in a hotel. And let's say you're not staying, in your property, you can write that off. There's education. A lot of times there are real estate conferences. So there's a number of different tax deductions that real estate investors can take. Cell phone, internet, office supplies, buying computers, printers, et cetera, et cetera. If these items are being used in your business and they're considered ordinary and necessary, those are legitimate tax deductions.
Yeah, makes sense. And it's also good to just make sure you're keeping track of all of those things that you're doing, because sometimes we're just like, oh, we'll go to this conference or we'll do this thing. And it's like, no, you should really be thinking about that more strategically from an operational perspective as you're running this really like a business.
Absolutely.
Can real estate losses offset other types of income? I know we kind of touched on it before. And what should people know more about when it comes to passive activity rules?
Okay. Well, as I said earlier, real estate can offset your W-2, what we call ordinary income. And there's two different ways that can be done. And it depends upon what type of real estate investment that you have. If you have a long-term rental, as I said earlier, you're allowed to take up to $25,000 in losses if your adjusted gross income is $100,000 or less. As your adjusted gross income rises and it gets to the $150,000 limit, those losses are suspended. It doesn't mean you can't use them. It just means you can't use them now. You get to use them in the future when you either sell the property, you don't do a 1031 exchange, or if your income goes below $150,000 or below $100,000, which could be, when you retire in most cases for people who are, high earners. So I tell my clients the losses are put in the bank. They're there and you can use them. You just can't withdraw them right now, but you can withdraw them in the future. With a short-term rental, If you manage the property yourself, that means you don't have a property manager, and you meet what's called material participation rules. And there's, a number of different rules, but the most common one is you spend at least 100 hours managing that property, and you spend more hours than anyone else, including like a handyman or including cleaners. And cleaners are probably going to be your, the person that spends the most time at the property besides yourself. But if you, spend more than 100 hours, and you spend more time than anyone else, you can take very large losses against your W-2 income. So what I normally see in that kind of instance is where you have a married couple and then one spouse stays at home, but they manage that property, and they get, to meet the material participation rules. And then you can take, unlimited, amount of deductions. You can do a cost segregation study, and you can get tens, hundreds of thousands of dollars in tax deductions in that year that you do the cost segregation study. And that can be utilized to offset your W-2 income. So that's a common strategy for high earners that, have a stay-at-home spouse, or, someone who has a job where they can work from home remotely, and they can still manage their property, using technology like electronic locks and, platforms like Airbnb and VRBO.
Yeah, it definitely makes sense. I feel like there's so many nuances here and how to really utilize that and from an operational standpoint. Now, I know, of course, we're in an interesting economic environment, and a lot of people are looking at downsizing, and, I see a lot of for sale signs even going up around me. So when it comes to home ownership, what tax benefits do homeowners miss out on when they're selling their primary residence that they may not be thinking about or even know about?
Okay. Well, the most common benefit that homeowners can utilize is the homeowner's deduction when they sell a property. So the IRS allows you to take $250,000 and appreciation and not pay taxes on that. So if you're a single person and your property you bought at $100,000 and you sell it at $350,000, you pay no taxes on that $250,000 gain. If you're a married couple, you can combine that, and now you have a $500,000 limit on your gain. So you could buy a house for $100,000, sell it for $600,000, and not pay any taxes on that $500,000 gain. So that's the biggest benefit to being a homeowner and being able to sell that property, is getting that $250,000 exclusion when you sell it. $250,000 per person, that is.
Yeah, which really makes a big difference and kind of leads into the next question around generational wealth, right? A lot of this is like, we do these things, we buy these properties, especially when it comes to real estate, so that at some point you do want to be able to pass that down in whatever format that goes into. So how can real estate be used to pass down wealth tax efficiently for future generations?
Well, sure. Yeah, real estate and home ownership is probably one of the greatest ways to pass along generational wealth. That's been the case for many, many years. But the key is you have to keep the property in the family, and you have to do certain things. So first of all, don't sell the property. Sometimes people don't keep up with the taxes as we get older. If they want a fixed income, like Social Security or IRAs or 401ks, you have to keep up with the taxes so you don't lose the property. That's number one. It's important to keep it in the family and to pay the taxes. And if the another generation, children, grandchildren have to do that, pay those taxes, help that person pay the taxes, it's really very beneficial to do that, to keep that property in the family. So never sell, number one. Number two, don't add your children or grandchildren to the property while you're living. So the IRS has rules about when you pass along a property, through an inheritance, and you get what's called a step up in basis. So a step up in basis means that, let's say you buy a property for $100,000, and when you pass away, it's worth $500,000. If you pass away and never selling the property, you don't have to pay any taxes on that sale, number one. Number two, your heirs, that means children or grandchildren, will get that property at its current value when you pass away. So they would get that property at $500,000, and they could literally sell it, the day after you pass away and not pay any taxes. Or they can keep it and build the generational wealth, and then their cost basis, would be $500,000 versus $100,000, which was the original cost basis when the original purchase happened. So, but if you add a child or grandchild to that property while you're living, and say make them a co-owner, something like that, then they don't get the step up in basis. So that's the key there, is like, I know that a lot of people think for estate planning purposes, they should add that person, but it's not helpful. I would say it'd be better to put the property into a trust, and the original owner would be the trustee, and then the children or grandchildren would be what's called a successor trustee. That allows you to keep the step up in basis. It allows you to do estate planning, but it doesn't mess up the step up in basis. Whereas if you add a second person to that property, like a child or grandchild, you would lose out on that benefit, and that's a really, really a great tax benefit. And a lot of people, like I said, they're not educated. They don't work with the proper advisors. They could, make that mistake. I see it happen a lot of times.
Yeah, it's a really, really key thing. And for those who are listening, who this might be their first time hearing about cost basis, do you mind just kind of breaking down that term
Sure.
for people who, just might be hearing it for the first time?
Sure. So when you buy a property, well, whatever you pay for it, that's your cost basis, or at least the building value is your cost basis. Again, as I said earlier, you can't depreciate land, so you only depreciate in the building. And so the building is your cost basis plus any repairs or any improvements you do to it. That means if you put on a new roof, you put on a deck, do something else to it. Those kind of things or improvements increase your cost basis. And so that's, what the IRS, the term cost basis means.
Thank you. Because I feel like sometimes we're, talking and it's just like, oh my God, what does that mean? Perhaps should I be thinking about that as it relates to me? So when it comes to really, understanding our mindset and our shift, right? What are things that real estate owners should be doing or adopting when it comes to paying their taxes, and as they start to really think about long-term wealth? Like, how do they really build that long-term strategy?
Sure, that's a great question. The best way to build long-term wealth is to hold on to a property long-term. I know a lot of people, they see appreciation and they're like, okay, I'm going to sell this and I'm going to get something bigger. That is great, and everybody wants to get a newer or bigger house, but instead of selling that property, make it a rental property. And that's a common way that real estate investors can become investors if they don't have the money to put down a 20% down payment. Buy a house and you live in it for a year, and then you can move out, which is, and that's one of the rules in your mortgage. You can't move out or make the property rental until you've been in it for a year. So a lot of times people, try to skirt the rules and they don't want to live in it for a whole year, but that could be problematic. So I tell my clients, buy the house, live in it for a year, and then move out. And if you want to buy a bigger house, you want to buy another house, great. But keep this first house you bought, make that your rental, and because you probably only put down 5% or whatever, and now you're a real estate investor. So that's one way of building wealth, is don't sell properties. If you want to get something else, just keep it and make it a rental.
Yeah, definitely take a second to think more strategically. I know sometimes we're always in a rush to just do or get out of something for whatever reason, but even just taking a day, a week or something to kind of just readjust our mindset a little bit might be helpful to someone really, again, like to your point, instantly become a real estate investor because of the property that they already have and not have to necessarily start from scratch. So as we, start to close out this episode, is there anything else that you feel like we didn't touch on that people really need to know when it comes to real estate taxation or even investing in general?
I would say if you're going to Sure. If you're going to get into real estate, you want to get a really good advisor, get a really good tax accountant, someone that specializes in real estate taxation. You might not be able to find that person at your typical, big box like an H&R Block or Jackson Hewitt, but there are real estate, accountants out here who specialize in this, and you want to have somebody like that on your team. You want to have an advisor that understands all the ins and outs, and so that you're not going into this blind. Even if you have your own education, unless you're a professional accountant in your day job, your tips and tricks and things that are out there, landmines that you could avoid if you have someone like myself or some other real estate professional on your team. So, I always say real estate investing it's a team sport. You got to have a broker, you got to have a good, real estate agent. You got to have a good accountant. And you need to have maybe a good contractor, to help you, fix the property. And if you don't have these people on your team, it's going to really hamper your success.
Yeah, absolutely. And keyword team, have a financial team in all ways, especially when you're looking at all types of different things, especially when it comes to real estate investing. So you know what you're doing, right? And it's not just solely on you to figure out how you're going to show up and fix this, and also do the operational stuff and figure out the strategy behind what you're doing, and also ensure that you're, building your generational wealth and leaving it in a way that's going to continue to make sense for you and your family. Well, Bill, thank you so much for hopping on this episode of the podcast. I know there was a lot of gems dropped, and a lot of people had some great information to take away, especially if this is something that has been top of mind for you. You're currently, working on this, or this is something that you want to do in the future. So, Bill, thank you so much for your time, and I know that we're going to have you back.
Well, thank you, Dana. It was a pleasure. Look forward to it.
Awesome. All right, everyone. Well, make sure you tune in for another episode of the Zone of Genius podcast, and we'll see you soon. Take care. Thanks for tuning in to the Zone of Genius, where we make money make sense. If you felt seen, heard, or inspired today, don't keep it to yourself. Share this episode, leave a review, and tag us in the moments that moved you. And when you're ready to stop doing it all alone and start building your financial team, visit chipprofessionals.com, and we'll connect you with trusted experts who will help move you forward with strategy, support, and confidence. Until next time, stay in your genius.